Hi, Jeff Fastov here. I'm co-head of credit strategies at Square Mile Capital Management. I get the question all the time, how do debt funds exactly fit into the lender world? And, it's debt funds are also known as non-bank lenders. So I think the answer is right there. Not surprisingly, debt funds or non-bank lenders lend where banks can't or won't make loans. So that's typically a higher leverage situation, maybe a property transition, a value add or development angle to it. And the reason the banks don't focus on these particular parts of the mortgage market is they really don't have the deep expertise as owner developers. So if there were issues, they really can't step into the shoes of the borrower. And also, these kinds of loans, particularly if there is credit stress, have very high capital charges. So the cost of holding these investments reduce the profitability quite a bit. And then lastly, I would say if banks get a little too aggressive in their lending, which is oftentimes associated with the stress that came from the GFC and other cycles, their constituents get a little bit edgy. So whether that's regulators or stock investors tend to punish banks when they get too aggressive with their lending. Another perspective is thinking about it from the borrower's angle and from the investor angle. What makes a debt fund or a non-bank lending strategy interesting? Well, let's start with borrowers. Borrowers either have equity, common equity, or they borrow money or debt. And debt, you could think of if it's fuller than a typical bank loan, is cheaper than common equity. So they have more upside if they can borrow more. Maybe they don't have to raise capital and dilute their ownership or control over properties, and they get more upside by borrowing in a fuller way on the debt side. From the investor's side, particularly if the lender has the experience as an owner to manage risks within their portfolio, kind of the opposite of what I described with the banks, then there are good risk-adjusted returns. And particularly for institutional investors, interest rates are so low around the world in their bond portfolios that this product is an excellent fixed income alternative for them. There are also different kinds of vehicles that investors can use to access exposure to non-bank lending products. For example, public vehicles, the REITs, they're attractive for many reasons. From a issuer's perspective, if there are opportunities in the market, they can issue new stock overnight and attack very, very large scale opportunities. Also, it can be accretive. Let's say if the stock price trades above the actual book value of loans, then it's accretive to take that capital and invest it in real estate. But the opposite is true as well. If it's trading below book value, it's dilutive to raise more capital, and that might constrain the ability to go after opportunities, particularly because trading at a discount oftentimes is associated with real estate being a better value or cheaper. So that's definitely an issue. Maybe something in between that and a closed end would be a permanent vehicle or an open fund. So this is not traded on the stock exchange, but it is an open permanent vehicle, and investors can add to their portfolio over time. If your AUM is going up as an institution or as a private wealth client, you can, if you like the strategy, you can just add to it over time. The other side is redemptions. These open-end vehicles do provide, oftentimes on a quarterly basis, for investors to request their money back. There's a whole mechanism for managing a queue of redemptions. And I do think investors understand that in a period of extreme stress, it could well be that many investors will ask for redemptions, and it'll have to be managed over time. So it's a balance there. And then there are closed-end funds. Closed-end funds or they're defined by a specific period of time to raise and deploy capital. It's a way for investors to get a more narrow exposure to a particular market or cycle. It's an easier way to create incentive fees tied to a specific portfolio for the manager. So they may get carried interest, for example. So, one question is, what do you look for in a debt fund manager? Well, consistent with all managers, start with the track record. How have they done? And in particular, just coming out of COVID, COVID is a bit of a stress test for everybody. And particularly for debt funds, where leverage is used to enhance returns, usually, almost in all cases. I think it was a reminder for investors during the COVID period that how you manage liquidity and your liabilities is just as important as the investments you make. So a good investment that's not funded in a stable manner can create losses that can otherwise be avoided. So I think that track record, and in particular, how liabilities were managed, is something to look at. The other thing that I think is essential is, as I was describing, the non-bank lenders make loans banks don't want to make, so they're higher levered or they're more dynamic in nature. So being an owner developer and having that expertise, and just as importantly, integrating it into your lending programs is key, because if there are ever issues to deal with, they will have the capability to pursue all options to maximize value, not just, let's say, sell and get out of a position to someone who's going to look to make an extraordinary profit. The manager, if they can hold the asset and deal with it themselves, will preserve that for their investors. So that's very, very important, I would say.